Hello and a warm welcome to Talking Stocks. I'm Gugulethu, Cele. In studio with me, I'm joined by Peter Armitage and Sean Ashton, both from Anchor Capital. Now today we're talking Mediclinic, an international private hospital group with operations in South Africa, Namibia, Switzerland and the United Arab Emirates, and listed on the JSE, the South African Securities Exchange, since 1986. Gentlemen, good to have you with us both. Looking at Mediclinic, I think a lot of South African consumers will be familiar with some of the hospital groups that we often drive past the buildings there, or if you have an unfortunate accident, maybe you'll spend the night at. But clearly this is an organization with great global reach, right, Sean?
It's changed significantly in the last 10 years. I mean, if you look back to 2007, I think the two major hospital groups, or two of the three major hospital groups in the country, took the decision to externalize. That was Netcare and Mediclinic. Netcare went first in 2006 into the UK, and Mediclinic did a similarly large deal in Switzerland, where they acquired London, which is the largest private hospital group in Switzerland. And since then they've done capital raises to pay down a lot of and restructure the debt. And now you've got a situation where actually only 25% of the profits of Mediclinic come from South Africa.
Sure.
The rest is Switzerland and the Middle East, and that's going to change even further going forward.
Let's take a look at that graph, the geographic mix of earnings. Clearly, Sean, it seems as though Switzerland has a heavy weighting here, but naturally with the UAE also situated there, then significant benefits when it comes to the forex earnings, right?
Yeah, absolutely. So if you look at Switzerland, it's probably, I would guess, 45% of earnings now. As we've said, South Africa is about a quarter. And if you look at what's happened to the Swiss franc versus the rand since their financial year end, versus the average of their FY15 year, the rand's now 17% weaker. So you've already got a tailwind of about 17% on almost half of your earnings. And we know that the rand versus the dollar has also been weak. So from the perspective of what's happening in the UAE, where it's really a dollar economy, you would expect to see a tailwind coming through there. Last year's numbers were a little bit of a disappointment to us, but when you look forward, we think there's quite good earnings momentum into the next year, and actually at these prices now, Mediclinic's probably trading at a forward 20 PE.
Geographic location and split is obviously quite a benefit, but again has headaches when it comes to regulatory approvals in the different jurisdictions, but also presents quite a few opportunities. Maybe let's walk through some of the positives and negatives in the key attributes here. Yeah. Pete, feel free to come in and tell us why you like it some more.
So I think getting all of these deals done, there's obviously a lot of complexity. But I think ultimately shareholders and a share price, the guys will look through to the end equation. As you get into different territories, there's different tax and there's different, you need Reserve Bank approval to a certain extent. And at the end of the day, there'll be hospital, and in South Africa, as you well know, they're intending to regulate hospitals. So you're constantly faced with those kind of threats. But ultimately, if you look at the share and you look at the business, you're sitting with something which is underpinned by hard assets. It's in a way kind of a property company. What they're doing is renting out space and providing nurses. People always fail to realize that hospitals don't actually hire the doctors. The doctors are independent agents. And you've basically got a customer base which is about as solid as you could hope for. Because ultimately when somebody needs to go to hospital, it's not a discretionary expenditure. There is an element that's discretionary. There's some surgery that's discretionary. But the core base of what you're doing, and if your hospital's in the right location around the world, and as you move into developed markets as well, populations are aging. So there's always an argument that for the same 80 million people in a territory, you'll have higher hospital visits. Technology is the other side of that, because they try and keep people in hospital for lower time periods. But ultimately the trend will be, a hospital is typically, if it's in the right place and run well, an excellent asset to own over a sustained period.
Maybe if we take a look at the rationale for them to go into the different jurisdictions, and picking up on Switzerland first, like you've alluded to as well, Al Noor, if I'm not mistaken. Now that's the company that they've bought up in Switzerland. The kind of prospects
so that's the Middle East.
Oh, that's the Middle East.
And that hasn't yet happened. There's been a recent announcement that Al Noor and Mediclinic are considering a combination of their businesses. That's quite an interesting one, because there's literally a press release that's come out this week. Now, Al Noor is much smaller. It's a $1.5 billion business versus $5.5 billion market cap for Mediclinic. But when you look at Al Noor, so it's three hospitals in Abu Dhabi, in the UAE, and then Mediclinic's exposure there is in the Dubai market. And the two of them have tried to get into each other's markets unsuccessfully. And now this is obviously a conversation that's come up around combining the two businesses. But it looks like if it does happen, what it's likely to happen in the form of is a reversal of the Mediclinic assets into Al Noor's listing. So ultimately, Mediclinic shareholders, because Mediclinic is so much bigger, will end up controlling Al Noor itself if that happens. And you get a London listing out of that process as well for Mediclinic, which I think is potentially important in the sense that they've already bought 30% of Spire, which is a UK private hospital group, much smaller than Netcare's business there. But they have the opportunity to potentially take up more of a holding and potentially a controlling stake in that asset over time. And I think having a UK listing may well help with that. So clearly what these guys are trying to do is internationalize the business and bulk it up. And I think out of that process you may well have procurement synergies across the businesses that are operating in like-for-like territories, like, for example, the Middle East.
If we come to the price-earnings multiple, though, and look at the chart, something happened in October of 2013.
So they obviously reported a statutory loss during that time period, which is why you see on that graph the PE multiple actually goes negative. We haven't shown the negative, but it's not really meaningful in the sense that they had a restructuring of their Swiss debt, which resulted in once-off charges that resulted in a statutory loss. But on an adjusted basis, they remained profitable if you just look through sustainable earnings. But you can see that over time this has been a highly rated stock. It's not very cheap relative to its history, but it's also not trading at peak multiples, if you would say.
I think as well, it's becoming one of those, in a South African share portfolio. Typically, guys, if they want a long-term portfolio, they've got the big quality global companies. So typically somebody who has some South African brewery and some Richemont and some Remgro perhaps and the like. Mediclinic is becoming, and particularly with the acquisitive activity that they've done and will follow, it's becoming a really big global business. And I think will start to become kind of, from a small hospital group 10 years ago that was South African based, it'll become a share that people will have as a core of a portfolio. And I think, interestingly enough, a lot of this it has been done and sourced out of Stellenbosch before. If you go and look at the history of Richemont, started by ultimately the rich families down there, the Ruperts, they developed Richemont into a huge, big global business. British American Tobacco was another one. And this is really another leg to what they've been able to achieve.
So I take it then we shouldn't be comparing them to the local South African hospital groups, as you've alluded to, clearly in a different league of its own. Are there international competitors that might want to eat into its lunch?
When you think about it, the odd one out actually is Life Healthcare, because they were the only one that didn't do what I would call a bulge bracket offshore deal. They have done some smaller bits and pieces in India and Poland, but they're the only one of the three that's actually largely a South African business. Netcare has got a very big business in the UK in the form of General Healthcare Group. It's actually bigger operationally than their South African operations, but because of all of the debt that they still have there, which they haven't yet managed to restructure, it's a tiny component of profits. But certainly operationally, all of them, with the exception of Life, are actually pretty much offshore businesses now.
Tell us why we should be potentially looking at it. We have seen a significant sell-off in the markets, especially on the local front. Mediclinic has also been one of those which has been impacted. Does this present then maybe a buying opportunity here?
I think if you're worried about emerging markets generally, this is a great asset to hold, because you're getting rand hedge exposure into what is quite a defensive profit stream. So it's not a cyclical business at all. And secondly, it's a good way to externalize money into hard currency assets. So, for example, if you're buying something like, for example, British American Tobacco, they operate in emerging market currencies. So if the rand weakens, it tends to weaken alongside other emerging market currencies. So BAT in that context lands up being less than an optimal hedge. Whereas there's something like Mediclinic, where 80% of their profits now, if you take into account a possible Al Noor tie-up, are outside of South Africa, and specifically in dollar and Swiss franc earnings, as opposed to other EM countries.
Exactly. Would we want them, though, Pete, to look for other opportunities elsewhere in other emerging market or even developed economies then? Because clearly the capital raising and capital expenditure on these acquisitions is
I think the focus has been to internationalize the business into developed markets. You could argue whether Dubai and surrounding areas have an element of emerging market, but I think they're well beyond that. So I think they've still, the transactions that they've done and looked to still be doing will eat up a lot of their capital and management time and expertise for quite a while. So I think really that they're focused, that, you know, that's really, I think for the next 2 years where they'll be putting their time, effort and energy and capital. I'm sure thereafter they'll look at further global expansion. But as you know, the world can change quite quickly over a year or two, and it'll be a case then of seeing where the next exposure lies going forward. An interesting one Sean was talking about, so Life Healthcare obviously took a strategic view and decided India is the next growth area. And they've gone there, paid a lot of money for an asset, hasn't really worked. Whereas they've gone for more paying proper prices for developed market, established, valuable assets. And they've paid up. I mean, Mediclinic in the bankers in Switzerland were amazed with what Mediclinic was prepared to bid for their assets. But ultimately, it's landed up being I think also since they've done it, the Rand's weakened a lot. So Mediclinic in Rand certainly looks good. But it's, you know, they've focused more on quality than trying to find a bargain.
Time now to find out from our experts whether to buy, hold or sell Mediclinic. Pete, your view?
So it's just gone up about 20%. It's back to close to its all-time highish levels, probably 5 or 10 Rand below. I don't think it's a share that's going to race away, but we really like it. It's a quality business. It's in our portfolios. I'd hold it for the next. It really is a kind of a 3 to 5 year holding stock. So I'd buy it, but not be in a particular hurry.
Exactly. Take it you agree then, Sean?
Yeah, I think I'm pretty much on the same page. I mean, it probably in the short term might have got a bit heated at 130, came back to 100. That's where we really upped it in our portfolios, and it's back to 120-ish levels. But I think over a 3 to 5 year period, I'm very happy to buy it.
And management's view, when you take a look at the recent results that came out and the level of commentary that they give, are you still fairly confident on the direction that they're leading the company?
I think they're very conservative managers. I mean, despite the fact that there's been a lot of corporate activity, I think operationally they're very conservative. And when you look at for example, the South African business, the margins have been pretty static in that business. And I think the approach they've taken has been very different to the likes of a Life Healthcare, where they haven't really sought to maximize margins. They've rather said, you know, we're running a business for the next 10 to 15 years. We've got to make sure that our nurses are happy and well paid and not focus on every last little cost line item, which you might argue is a different, maybe that's what they should do, but I think it's a very conservative approach.
So there's a smell of quality about it.
Yeah.
Smell of quality. We'll leave it on that line. A powerful, punchy one for the hospital group being Mediclinic. But that's where we leave it for this week. Be sure to catch us again next time when we talk more stocks.
For the latest fundamental and technical analysis delivered right to your inbox, log on to talkingstocks.co.za and sign up for the Talking Stocks newsletter.